start this discussion. Thank you very much for joining us. This is, I believe, quite an interesting and timely discussion today. We are here to discuss how autocratic countries present a risk for investors. And it's a subject that I believe is under-studied, under-discussed. So I'm very excited to have two great speakers and people who have a real vision, I would say, in this field to discuss the risk presented by autocracies. Before we jump in, I'm going to quickly introduce myself. My name is Philippe Bolopion. I'm a managing director at TOBAM, based in the New York office. You can't see very well behind me because there is so much sun, but it's a beautiful day in New York. I did most of my career in journalism and in human rights. I arrived in New York in 2000 and spent 10 years covering the United Nations for the newspaper Le Monde and traveling around the world covering crisis. And then I joined for 13 years one of the two biggest human rights organizations in the world, Human Rights Watch, which is also based here in New York. And I met Yves and Tobam about 2 years ago. I got really excited about the LBRTY strategy that they were working on. I believe it's really potentially transformative by bringing, the lens of democracy and human rights in the universe of finance and investment. And so that's why I'm really excited to host this discussion today. So we'll have both Marcos and Yves do a presentation for you, probably around 20 minutes each. And at the end of this, we'll open it up for discussion. I'll take your questions and Marcos and Yves will answer them. So Marcos, thank you so much for joining us. It's a real privilege to have you. You have written, I believe, the most important book in the field of democracy and human rights, which I highly recommend to anyone who is interested in this subject. Before you jump into the presentation of the book, why you wrote it, why it's probably a really timely moment for it, would you mind introducing yourself quickly for our guests?
Great. Thank you, Philippe. Thank you, Tobam, all the Tobam people for the invitation to participate here. And thank you for all the participants for joining us. Well, I'm an economist. I've been working for decades in emerging markets. I work for several years at Citibank both in Buenos Aires, Argentina, and in New York, and then at Bank of America, where I was the head of the Latin American economics team. For almost 10 years, I have a consulting company who's on economics of South America, whose main clients are institutional investors. And why I read the book, because in my professional throughout my professional experience, I realized that oftentimes unwittingly, my own clients were financing, and I saw it in real times, autocrats and the demise of democracy in countries of the region like Venezuela and successfully in Ecuador and other countries. So I realized that there is a relationship there between what's going on in markets and democracy that I needed to bring awareness to the topic. So I think that in the same way as some people brought awareness about the impact of companies on the environment, and then there were financial solutions to that, I think there is a parallel here. We all care also not only about the environment, we care about democracy, and but there is very little that investors can do so far. And so I just wanted to bring awareness about this, and this is the topic of the book.
Great, thank you, Marcos, for this. And yes, I believe it's a very timely book, and an idea that's gaining ground. I think with a lot of investors, which is probably why we had such interest for this webinar. But without further ado, do you want to jump in and actually explain a bit what the book is about and what your thesis is?
Yes, great. So the title of the book is Beyond the ESG Portfolio: How Wall Street Can Help Democracy Survive. This is playing with the book of Levitsky and Ziblatt, How Democracies Die. There is a very famous book on the topic, and so the idea is that there has been a democratic recession in the world. If you look at here, you have the indices, the democracy indices of the Economist Intelligence Unit, and you have seen the decline in selected emerging markets. If you look at, and then the overall index, which according to the Economist Intelligence Unit starts to decline around the 2015. But if you look at Freedom House, another measure of democracy, the democratic decline has 24 years in a row now. 19 years in a row now since 2006, the democracy decline started. And this happens, across anyone measuring how democracy, is doing in countries. We talk about what is called liberal democracy for those in the US, and we're not referred to liberal as in the American sense, but liberal in the sense that it's not only that you go to vote, but that you have human rights, that is independent press, independent NGOs, independent the judiciary. There is a whole set of political rights that have to be respected to be a liberal democracy. And there has been a democratic decline, and I concentrate on emerging market countries first because that's my expertise, but mostly because according to democracy expert Larry Diamond, this democratic decline took place particularly in a set of what he calls strategically important emerging market countries, right? Like Turkey, think of Turkey and Russia. And third, because these countries typically have small capital markets, and so they depend on foreign capital. And so that's why, I want to make the link between Wall Street, and financial Western financial markets and what is happening with democracy. They depend on foreign capital. So there's a democratic decline, and as you can see, at the same time that there was a democratic decline, if you concentrate on the red part of the bars on the chart on the left, there was a surge in capital flows, in around the year 2006 when this democratic decline started. And if you look at the chart on the right, capital flows to these countries, including China, have remained, with ups and downs, but overall, very, very high in recent years. So again, we see on the one hand, all these democracy watchers measuring that democracy is declining. Democracy is not a binary variable. It's not that like in the past that they will coup d'état. Sorry, for my French friends how I'm pronouncing that. But now democracy declines in a slowly, right? Slowly. So, and that's why it's not a binary variable. But there is a democratic decline just at the same time as the portfolio flows have increased. Actually, if you think at I will talk about how this happens next, but I will show you some numbers. But the idea is, why does it happen if we don't want that? We all care for democracy. Well, what you find when you start digging is that most of this financing, this link between what I call Wall Street, but let's say Western financial markets, developed markets, and democracy in emerging markets, happens through indices because the owners of the money, the pension funds, hire specialized companies to administer their money, and these companies have to use benchmarks to say, I'm good or I'm bad. And these benchmarks, as it happens, they include a lot of autocratic countries. Think I'll just give you a few examples, but the JP Morgan MB Diversified is the most tracked benchmark in the sovereign bond index, government bond index. And 45% of the countries included were characterized as hybrid regimes or authoritarian regimes by the Economist Intelligence Unit of those included in the index. In terms of weight, 38% were classified as such, and these include countries like China, Russia, Egypt. So if you're an institutional investor that offer your services to the owners of the money, let's say the pension funds, the university endowments, etc., you say, I have to track some index to tell you whether I'm good or bad, and say I'm going to track the JP Morgan MB index. Well, you have to invest in countries that are you're forced to invest in these countries that are non-democratic, because if you don't, you lose money. I remember very vividly how when it was very clear that Venezuela was not a democracy anymore, some big institutional investors were still investing in Venezuela because the yields were so high of these bonds that they couldn't avoid investing. Otherwise, they would look very badly in front of their clients. Think of this, how big this can be. When China was included in the one of the biggest bond indices in the world, the World Government Bond Index, the process started in November 2021 of investment. The estimates were that between 140 and 150 billion dollars of money would be invested from Western investors into Chinese sovereign bonds. Just at the time in which we saw very clearly the increase in the autocratic behavior of the Chinese regime, not only at home but also abroad. If we go to the equity world, it's the same. This is the most tracked index, the Morgan Stanley Emerging Markets Index. And if you see, 9 out of the 24 countries are authoritarian or hybrid regimes, according to the Economist Intelligence Unit. This is in 2023. And the weight in their index is even higher because just China comprises 25% of the index. And think of this, how important have emerging markets become, that when Morgan Stanley launched the MSCI in 1998, the emerging markets were only 1% of the total index, of the global index. Now, by 2020, they were already 13% of the total index. So they're increasing. There is an increasing allocation of assets into emerging market countries by Western investors. So so I show you the democratic decline, and at the same time the increased flows to emerging markets and some of the avenues by which this happens, that is the inclusion of the index. And I think that what I also wanted to show is that at the end of the day, it's not only that this investor may not be doing good, but they are also probably not gonna do. It's not gonna be a profitable investment. And as an economist, I first try to go to the basics, and the basics is that there is a lot of debate, as everything, of course, that we economists do, and there's different opinions, but I think that over time the literature has become more in the direction of showing that more democracy means more growth. I mean, I think that this inflation paper about Nobel Prize winner Acemoglu and others, particularly, you see the chart here, shows that a country that transitions into democracy achieves a 20% higher GDP per capita in the next 25 years compared to a country that didn't, according to this paper. And let me go to the paragraph below, and then I go to these findings, I use official GDP data. There is a very influential and more recent paper in the Journal of Political Economy that says, well, be careful, because you may be overstating the rate of growth of autocracies, because what he finds is that they overstate GDP growth by 35%. The results of Acemoglu et al. May be even more robust. Then another way of seeing it is this: a way to make democracy die is populism. And of course, being from Latin America, I've read and I lived through a lot of populism, and populists are one sort of autocratic leaders that tend to divide between us and them, and undermine the free press and the judiciary. And there is another very influential paper by Funk et al. That what they argue is that a country that goes into a populist regime after 15 years, GDP per capita falls by 10% compared to the non-populist counterfactor. So again, the evidence tends to show that to suggest that countries that grow that are the more democratic grow faster, and you think, well, this should have some impact on your investments, because if a country grows faster, the companies that are there or the companies that sell to these countries or that are sourced from these countries are likely to do better, right? And the same for the bonds. I mean, if a country grows faster, well, tax revenues are likely to be higher, and then, the capacity to pay the sovereign bonds is likely to be higher. So there must be a link between, the two of them. And there's, to be honest, there's not a lot of literature on that final part of the link, right? But there is some. For instance, these people, Ley and Wisniewski, using a sample of 74 countries in a long sample, what they do is they design two portfolios, a high democracy and a low democracy portfolio, and they show that returns in the long run are significantly higher for the high democracy countries compared to the low democracy countries. So again, this is the avenue. So one should ask, why does this happen? Why does and it's not only because of, if growth is higher, profits are likely to be higher. It's not just like direct link, I guess, that works. But I think there are several other avenues by which that happens, and these are. There are several, I'm just summarizing, what I have in the book, but let me tell you some of them, is that at the end of the day, in countries that respect human rights, well, they also protect property rights, and the other way around. I mean, if you live in a country where human rights, in a broadly defined, let's say, your free press and independent judiciary, and again, the way I defined before what a liberal democracy is, they tend to respect also property rights better. I mean, property rights defined also broadly, right? Like rule of law. I mean, so this tends to happen. And what also, there is a lot of literature. I just cited Stulz, that is one finance professor that did a lot of research on this. That is, when the expropriation risks are high, and when I mean expropriation risk, is not just the risk that your company is going to be nationalized, but expropriation risk meaning that you're going to be subject to taxing regulations and changes in contracts, and so that at the end of the day, conducting business is not like well-defined set of rights for you and regulatory environment. And well, the optimal response in the private sector sets changes in the structure of firms that tend to affect both the minority shareholders and the growth of the economy at the same time. And because the optimal response is to hide, to be more opaque, to make your companies, let's say, report less profits than they were really report, and then to how do you do that? Well, you funnel some of these profits into the majority shareholders, and then, well, then you know that if you're a minority shareholder, you're not going to be remunerated as you would in a company, in an equivalent company in a developed country, and there is a higher discretion by the majority shareholders. And that affects minority shareholders. So at the end of the day, there is less investment because there is less capital. Look at the capital markets of the traded companies, the publicly traded companies of less democratic countries tend to be smaller, right? Better checks and balances also reduce corruption. Remember that in many countries, in some countries like China, companies can be said that they are at the end of the day, not that they work for the government, but they're heavily, managed by the government. But in countries that doesn't happen, you often see that companies, to remain in business, have to play with the government, and that reduces profits. It's not only corruption, but that you have to do actions like a public road or things to keep the autocratic leader happy, that at the end of the day reduces the profits of the shareholders of the company. Well, political risk is also lower, and for more practical and for more not practical but for more interesting results, you see that in countries that have worse quality of democracy, you see a lot of downside risk that you don't see in more democratic countries. Look what happened in Russia, the equity market after invading Ukraine, what happened to the Chinese education stocks in 2021, to what happened to this food company in Egypt in 2021, what happened in Turkey this year when the government imprisoned the main opposition leader. So these are just some episodes, but the point is to show you that when the country becomes less democratic, downside risk for equity investors tend to be higher. So just to summarize, so what I did so far is to show there is a democratic recession that happened when capital flows increased to emerging market countries. I suggested that the indices are the bond and the equity indices are an avenue by which this happens. I forgot to say that this is also happening at the retail level because the retail investors invest through ETFs, and these ETFs are benchmarked to those indices. And then what I try to suggest is that probably you're not only doing bad from in the sense of supporting autocratic countries, but you're likely to do worse. So then what I do in the book is to suggest a way to get rid of this problem or to control this problem in your portfolio, and this is to at least try to exclude the highly autocratic countries. What I find highly autocratic is that are in the lowest category, but at least two of the democracy indices. I'm talking about VDEM, Freedom House, and Economist Intelligence Unit. And if you look at the list of the countries, it makes a lot of sense, the countries that I've included in the list. Well, and just to finish, my first and main objective at this point is to raise awareness. I mean, they cannot be a solution to an issue that is not seen as a problem. And the problem is that markets finance autocrats and wannabe autocrats, just as they are undermining democracy standards in their countries, and also companies that sometimes are the puppets of autocrats. And that most of the times this financing takes place unwittingly. I mean, most people don't know that in their portfolios through their pension funds or ETFs that they're buying, that they're doing this. So the point I want to raise is they are doing that. You're not aligning your investment with your values, and you're likely to do worse off than what you could do. Well, and the second objective, of course, is to propose alternative. And the alternative is to try to mimic what happened with environment and finance, and that is to incorporate democracy standards to investment decisions. And again, thank you very much for your attention.
Of course, thank you so much, Marcos. Great presentation. So if I try to summarize quickly what you laid out for our colleagues who joined a bit late, you are showing that there is a democratic decline in the world that has been going on for 20 years now. So the world is actually much less democratic today than it was 20 years ago, even than it was when the Berlin Wall fell in 1989. So democracy is going down. You're showing that during that time, the democratic world, the richest countries, the US and Europe, have invested massively in autocratic countries, and this trend has been essentially facilitated or normalized by the big index providers and the benchmarks. So it's become completely normal for everyday investor or institutional investors to invest in China, for example. Clearly, it's a trend that's bad for democracy globally. The biggest beneficiary of this trend is arguably China. And China is probably the most powerful government that has worked, I would say, as a former human rights expert myself, that has worked the hardest to undermine democracy globally. So we are financing essentially a government that's trying to undermine democracy. So it's bad for democracy and for the world. But you're also showing that it's bad for investors and probably not profitable. So essentially what you describe is, I think, a systemic problem that should be very high on the agenda of investors. It's also a problem that in many ways has been ignored or missed by a lot of people in the world of ESG or sustainable investing. whatever word we want to put on that. But you're describing a really important, I think, systemic problem. And what I believe Yves and Tobam have done is actually research this issue and propose a very innovative solution to it, which is why I think the LBRTY approach is really exciting. So Yves, I'll pass it on to you to maybe quickly first introduce yourself for our guests, and then explain what solution Tobam is proposing to this problem that investors are facing.
Thank you very much, Philippe, for the intro. Thank you, Marcos. It's always a great presentation that you give. There is only one thing that is more fascinating than your presentation. It is your book. So really, I cannot but encourage everybody to read it. It's something which is really fascinating. It's something which is so full of common sense that I think we cannot ignore it. So I'm not going to introduce Tobam. I am the founder of Tobam. You know that Tobam is an asset management company. We run mostly money for very large investors from across the globe. 60% of our clients are in the US and 60% of them are state pensions. So Tobam got interested into human rights since 2009 when we decided, after plenty of discussion, to choose a field of philanthropy. So after plenty of discussion in 2009, we decided that our field of philanthropy would be, in a way, liberty and democracy. And we have decided at that time to allocate up to 10% of our profits to human rights NGOs. And this is how, across the years, we built closer and closer ties with human rights NGOs and research centers. And after we started doing the research on that, after plenty of years, in 2023, we thought that our research was advanced enough so that we could, in fact, propose an alternative way of investing, an investing that would take advantage, in fact, of our research. What was the idea? The idea was not about philanthropy anymore. So we are continuing on our philanthropy dimension. But the subject I will present you, has nothing to do with philanthropy. I usually say it this way, at Tobam, we are not priests, we are not rabbis, we are not muftis or imams. Our field of expertise is not good and evil. So what I'm going to tell you about has nothing to do with good and evil. I have always presented an asset manager as somebody which aims at trying to identify what works versus what doesn't work. And in fact, the problem with autocracy is that it doesn't work from an economic point of view. Democracy, respect of human rights, freedom of speech, promotion of diversity and pluralism, on the other hand, are probably the best way to enhance creativity and economic growth. In fact, there is plenty of research that proves what I'm saying, that proves that from an economic point of view, democracy doesn't work. There are literally thousands of articles about that. Unfortunately, most of them are in the economic field. None of them, or almost none of them, is in the investment field. The most, solid research has been even awarded the Nobel Prize of Economy last year to Acemoglu and his colleagues. I could summarize, I think, Acemoglu's research with one of his sentences. And one of his sentences is, there is no lasting prosperity without solid democratic institutions. What is our process, our idea? Our idea is to identify a new risk factor that we have called the autocracy risk factor. It's extremely simple. This is the first step. Identify a new risk factor that we have called the autocracy risk factor, and then build a portfolio which is very lowly as possible, exposed to this autocracy risk factor. So in fact, you could summarize our research into 4 findings. The first finding, it is that there is an autocracy risk driver, the same way that there is value, that there is growth, that there is high dividend or low vol. There is effectively an empirical risk factor which you can identify in stock markets, which you could call the autocracy risk driver. The second finding, it is that this risk driver is negatively rewarded for, If you expose this portfolio, your portfolio to this risk driver, you're going to increase your risk and lower your performance. The third finding, it is that most of the exposure to the autocracy risk driver is indirect. This is one probably of the most important findings. It is that you cannot say you're not exposed to Russia if you don't have Chinese Russian stocks. Not having Russian stock doesn't allow you to say, therefore, I'm not exposed to Russia. Before the invasion of Ukraine by Russia, Sogen was not a Russian bank, it was a French bank, but if you own Sogen, after the invasion, Sogen lost $4.5 billion out of their exposure to China, to Russia, sorry. McDonald's Canada sold 800 restaurants in Russia for $1. In fact, the immense majority of the exposure to the autocracy risk driver is delivered to your portfolios via holdings that are listed in democratic countries. We are going to see that at length later on. The fourth finding of our research, it is that the autocracy risk driver is independent from the other risk drivers, which means that you can build a portfolio which exhibits no other bias than a low exposure to autocracy versus any given benchmark. Our portfolio, typically, it has the same beta, has the same momentum exposure, value, growth, small caps, large caps, sector exposure as the benchmark. The only difference between our portfolio and the benchmark, it is that we have a very low exposure to autocracy when the benchmark, in fact, has a huge exposure to autocracy. In fact, in a nutshell, if I wanted to summarize our investment thesis, it is that we believe that whenever you are exposed to autocracy, you are in fact exposed to a reverse J curve. You could, if you're very, very lucky, make some money, for a few years, but at the end, you're going to lose everything. There are so many of those reverse J curves that we have been able to discover. The most spectacular, the most devastating of it, of course, was simply Germany between 1933 until 1943. It was exactly the most growing stock markets across the globe. And you were making tons of money if you were invested in Germany between 1933 until 1943. At the end, you would have lost everything, including the only thing you don't want to lose when you've lost everything. What is it that you don't want to lose when you've lost everything? Your soul. And in that case, you have also lost your soul, which is in fact what happens most of times when you invest in autocracies. The most recent of those reverse J curves is one that Marcos mentioned. It is Russia. You could have made some money investing in Russia. At the end, you would have lost everything. There is one thing that I would like to insist on. It is that you should not look at the weights that are invested in autocracy in order to be able to identify how much you are exposed to autocracy. According to a study by the University of Yale, published in November 2022, there were more than 1,000 companies listed outside of Russia that had to close their businesses in Russia after the invasion of Ukraine. And for those companies, it resulted into $240 billion of losses. And $240 billion of losses is much more than the ownership of Russian stocks by Western institutions. So most of the risk was indirect. Whenever you want to assess how much exposed you are to oil, you don't count the barrels of oil you have in your portfolio, you compute the correlation your portfolio has to oil. So whenever you want to assess any kind of exposure, it's always very important to wear your correlation glasses. And it is the same also in the case you want to estimate how much exposed you are to autocracy. So this was really the investment philosophy. Now let's move to trying to measure how much you are exposed to autocracy and how to build a portfolio which measure of exposure to autocracy is as low as possible. So at TOBAM, as you know, we are quant managers. Quants need data. And we are very lucky in that field because we have plenty of data. There is an extremely abundant data about all of these concerns. At TOBAM, typically, we use 7 different data sets. Let me describe one of them. One of them is VDAM. In 1789, George Washington was elected President of the United States. And some Americans were so proud with that a university called the University of Notre Dame came up with a project called the Varieties of Democracy Project. They wanted to measure the state of democracy across the globe. Today, we would not say the varieties of democracy anymore. We would say the pillars of democracy. And since 1789, VDAM is measuring from a data point of view, they are feeding a database about the situation of democracy across the globe. Today, VDAM is still alive. It's not hosted by University of Notre Dame anymore. It's hosted by the University of Gothenburg in Sweden. And today, VDAM consists into 3,700 country experts, affiliated researchers that keep on feeding this database. I cannot warmly enough invite you to go to v-dem.net to download their annual report, and you will find fascinating time series. You will choose a country, Germany, and you will choose one pillar of democracy, freedom of expression. You will choose a sub-pillar, journalism. You will choose a sub-pillar, the number of students taking journalism in universities. And you will be able to see the Napoleonic Wars, the First World War, the Second World War, the Cold War, the fall of the Berlin Wall. It's an amazing collection of data. So what is our data, our investment process? Our investment process consists into looking at all of those data from the 7 different sources. Do data about the functioning of government, data about corruption, about political participation, about political culture, about freedom of expression, about pluralism. When you have plenty of data, there are plenty of data processing techniques as well that allow you to synthesize all of those data into some synthetic indicator that we have decided to call the country CD rating. CD standing for Civil and Democratic Rights Rating. And for every single country in the world, our first step of process consists into providing them with a rating between 0 and 10. If you're 0, you're probably North Korea. If you're 10, you're probably paradise. And if you're below 6, you're probably not a democracy. If you are above 6, you may be a democracy. This is the first step of our investment process. The second step of our investment process will consist into excluding all the countries that are below 6, including all the countries that are above 6. And for those countries that are, in the gray zone, we have set up an investment committee composed of university professors, composed of experts from, organizations like VDAM that will tell us not whether they are a democracy or not, because it's a gray zone, but they will tell us whether things are progressing or not in those countries. As of today, in the MSCI ACWI, there are typically 12 countries that fall below the mark of 6. The third step of our investment process will consist into wearing the correlation glasses. I would say that this is probably the most important step of our process. Wearing the correlation glasses, assessing stock by stock how much every single stock is exposed to the autocracy risk factor. If you take the example of German stocks, typically, or French stocks, you have Renault. Renault has a figure of 18% next to it. What is the mathematical of the 18%? The 18% is exactly the partial volatility conditional to autocracy of Renault. If autocracy goes down to sigma, Renault is going to go down twice 18%, 36%. It's really a partial volatility conditional to autocracy. How to understand that? How do we compute this 18%? The most easy way to understand how we compute it is to look at another stock. Imagine you consider, Bank of America, and you want to know how much Bank of America is exposed to oil. A very easy way to compute this figure is to compute the beta of Bank of America to oil. You will have an incredibly accurate indication of the effective exposure of Bank of America to oil. This is the way we do it. And now that we have the exposure of every single stock to the autocracy risk factor, we will be able to build a portfolio that minimizes this exposure under a constraint of tracking error. And this will be the LBRTY portfolio. Does it work or not? In fact, what I have described to you, step 1, 2, 3, 4, consists into an algorithm. So we have given this algorithm to an index providing company called Solactive in Germany, and we told them compute an index by applying this algorithm. And they were able to compute the index between 2008 until today. And when we looked at the data, we realized that there were 10 geopolitical earthquakes in those data. And systematically, the behavior of the strategy was the same. So if you look at the last of the earthquakes, took place in Q1 2022. It was the invasion of Ukraine by Russia. And in Q1 2022, the return of the MSCI emerging market was -8. Our return was +5. It's important to have in mind that the orange line is long only, fully invested, and doesn't own any derivative, is only invested in emerging market. And if you look at the orange line, you cannot even detect the day of the invasion. Minimizing your beta consists effectively into minimizing your exposure. Performance-wise, you don't want your performance to be exposed to this disastrous risk factor. So let's look a bit at the empirical results. Let's look, first of all, at the question whether we are effectively reducing the exposure or not when compared to the benchmark. So the benchmark is here. It's the ACWI MSCI or ACWI Bloomberg. It's roughly the same. Between 2008 or 10, 2009 probably, until 2025. And we have compared to the index a portfolio that would be simply whitelisting countries, that would simply exclude China, Russia, Pakistan, and this kind of countries. And you will see that if you simply exclude the countries, you will reduce on average your exposure by about 15 to 17%. So you still have a huge exposure to the autocracy risk factor. If instead of simply excluding the most visible part of the exposure, you wear your correlation glasses and you do the right job, it's not by 15% that you're going to reduce your exposure, it's by 85%. The difference is simply huge. Most of the exposure was indirect. It was through, an exposure to Volkswagen, huge exposure to China, an exposure to Sogen previously, huge exposure to Russia, exposure to Adidas. Those countries are completely Western company based in democracies, but they still have a huge exposure to autocracy. In terms of behavior, our strategy has always outperformed in the past with those two exceptions. It has exhibited a beta of exactly 1. We aim at a tracking error of 5%. We realized 5.3. The benchmark has 400 basis points of volatility driven by autocracy. It's huge. 400 basis points of volatility driven by autocracy. If you remove China and the allied, you will go from 4 to 3, because most of the exposure is indirect. And if you minimize the indirect exposure, you go to 0.6. Our portfolio does not exhibit any kind of, bias towards any kind of factor apart from autocracy. We don't have a sector bias typically. Sector allocation contributes to only 50 basis points of tracking error. And in terms of products, so far we have launched 4 products. We have launched, of course, a LBRTY emerging market, a LBRTY ACWI, a LBRTY ACWI US, and we have even launched a LBRTY US, because after all, there are some US stocks that are exposed to autocracies. And for the time being, all of them in their life performance have exhibited only positive excess return. If you look at the longer term, typically here you have the emerging market, the one that exhibits the highest tracking error, a tracking error which is 9% in the past. You will see that this year we have last year we have slightly underperformed the benchmark because of quantitative easing in China. But the year before, the index has outperformed by 14%, the year before by 11%, the year before by 9%. The other year of very strong underperformance was 2016, also the consequence of quantitative easing in China. So as a conclusion, if there was a few things that I wanted you to remember and to know, first of all, we have launched, and we were extremely happy a month ago when we have launched an ETF called BeFree, which mnemonic is BeFree in the New York Stock Exchange, in partnership with
Westwood.
Westwood, a Texan, asset manager, a Dallas-based Texan asset manager based in Dallas. What I would like you to remember, it is that we really believe this fund should be envisaged only from a risk and return point of view. Our aim is not to do good. It's not the main aim of the fund. The main aim of the fund is to try to be exposed to a risk which is rewarded. And the autocracy risk factor is not a risk which is positively rewarded. We really believe at TOBAM that diversification on one side and democracy, respect of human rights, etc., are probably the most powerful engine of innovation and economic growth. TOBAM really believe that a good way to enhance returns, it is to be exposed to the rule of law, as Marcos insisted in his presentation. Investing in the absence of rule of law is something that I would dare to qualify of being nonsense. It's nonsense. And you will see that many West companies that were very heavily invested in autocracies are paying a very, very heavy price for that. I mentioned a few companies in the past, Sogen, but I could mention about Volkswagen. I could mention the statements of Goldman Sachs in October of last year, when they mentioned that their JV of China never made any money for them across 20 years. It has made money every single year for the Chinese partner. And now for 5 years, they have tried to extract themselves from the JV, and they are not able to do it.
Great. Thank you so much, Yves, for this presentation. So essentially, Nobel Prize winning economists have shown that autocracy is bad for the economy at the macro level. And I believe what TOBAM is doing is showing that it's also bad at the stock level, and it's bad for investors. And it's a growing risk, because as democracy is receding around the world, its visibility in your portfolio is increasing, and so I think you're proposing a really unique and original solution to this problem. We are now going to move to the questions part of the discussion in the few minutes that we have left. Please feel free to write your questions in the Q&A. I already have a few, and the first one, which I was expecting, I think is on many people's mind and is almost a bit provocative in how it's framed, but I'm going to read it. It says, based on your views, we should sell all US stocks, at least during the Trump government. This might create a serious problem for global investors. What is your advice in this respect? So maybe, Yves, I'll give that to you, and Marcos, if you want to comment quickly on it as well, and we have another question lined up after that.
I would say that fortunately or unfortunately, our decision-making process is based on data. And for the time being, you know, the data consequences of the decision that the US government has taken or would take are not yet observable. The other thing that I would say, I would quote Acemoglu and say that probably one of the best ways to describe a democracy is to talk about solid democratic institutions. What the communication of the US government is providing us with is probably not reassuring with regards to the future. But as of today, I still believe that the the USA are a country with very solid democratic institutions. It's important to keep in mind that democracy is something which is fragile, and that we should monitor it, we should take care of it, with extreme care, in fact. And any attempt to solid democratic institution would be a disaster. But for the time being, when compared to the rest of the countries of the world, the US are still, from a measurable point of view, not from a communication point of view, I would say that the way the US government is communicating today is, to say the least, extremely innovative in terms of way of communicating. But for the time being, you know, definitely the US are still amongst the highest quartile of the most democratic countries in the world. Unfortunately for the other countries, but still we are very far from having an autocracy in the US.
Thank you, Yves. Marcos, any comment on that?
No, I mean, just to reinforce the idea, democracy, we can think of it as a continuous variable. So let's say if some of the things that we are seeing, you know, endure time, we're going to see is probably a deterioration in the quality of democracy. But I would think that it would still be, you know, thought as a, you know, liberal democracy by all the democracy watchers first. And second, as Yves said, you know, we still have to see, you know, the reaction of institutions like the judiciary, you know, independent press. So it's still a work in progress to you know, so to summarize, we cannot say that the US has stopped from being a democracy by any means at this point.
Yeah, thank you, Marcos. And to maybe give an idea of how the strategy works for our guests, we tend to exclude entrenched autocracies, not imperfect or struggling democracies. So as an example, we still invest in India, for example, because in the rankings, India still figures as a democracy, even though, as in many countries, it has receded there. So for us to consider even excluding the US, they would have to fall below India in the rankings, which so far we are not seeing with any of the data democracy providers. Great, thanks. I'll move to the next question, which is for Marcos. Marcos, do you see any parallel between recent changes in political leadership in Argentina and in the US and past transitions towards autocracy in countries such as Hungary, Turkey, Venezuela, or Russia? If so, what are the investment implications?
Well, I think, I mean, there are some parallels and there are some parts that are not, that we see in both countries, but particularly in the US, that we did not see in the countries mentioned. There is the parallel is that, yeah, there is let's say there is an attack on checks and balances, like the judiciary, the independent press, NGOs. So we see that in the US, we see that unfortunately also in Argentina. And that's the parallel, but you know, we're very far from seeing what we saw in Hungary, Turkey, Venezuela, Russia. Let's say take the case of Venezuela, you know, the case that, you know, is closest to me. And you know, Chavez changed the constitution. You know, I think during the first month in power. And basically he changed the constitution with a constitutional process that was not in the constitution. So he violated the existing constitution to do that. So that's so far, I mean, and he sacked the whole Supreme Court. That's so far from what we're seeing both in Argentina and the US, and the same happened in Russia. It was slower in Turkey, but again, there is a parallel in the direction of travel, there is not a parallel in the speed and the probable success of the travel, in my opinion.
Great, thank you, Marcos. Maybe a last question, since we are running out of time, and a question for Yves this time. So Yves, the idea that autocratic countries are a risk for investors is a new idea. Do you see it gaining prominence with investors? Is it an idea that's making progress in your view?
I think it's an idea which is an idea of common sense, and it's exactly the feedback we are receiving from investors. TOBAM stands for think out of the box. It's not because it's original, it's innovative, it's out of the box that it doesn't make sense. It makes plenty of sense, and we have never seen, for the time being, any client refusing a meeting about that. Because it's out of the box, it doesn't really fit a box. So very often it takes time, of course. But definitely, I really believe that the first reception we've got is very positive, and the feedback is very positive. We have some, very large state universities in the US that have started investing. Some of them have even accepted to seed 2 of our funds. So it's a first reaction which is very, very positive, and it's very often something that is qualified of being common sense. And like Marcos has said very eloquently, it's something that is missing definitely in the checklist of any kind of investing. As I said it even more strongly, I would say that investing in the absence of the rule of law is simply something that is nonsense. It's absurd. It's crazy.
Mm-hmm. And I would add maybe that in the current context of a trade war between the US and China, the strategy is probably likely to perform well, because not only the LBRTY portfolios are not invested in Chinese companies, they are also underweight in US or European companies that are themselves very exposed to China. So the moment is probably right to look at this type of strategies. But that's unfortunately all the time that we have. So I really want to thank everyone for joining this discussion. I want to encourage you as well to reach out to us and continue the discussion. We love discussing these subjects. There is a lot more we can show from a research standpoint. So we'd love to do that and have one-on-one meetings with some of you. And finally, I really want to thank Marcos for joining this discussion. I want to encourage you to check out his book and his work. I think he's one of the few people in the field who has really studied the links between autocracy and investment. And it's a great read. And I think a subject that more and more investors are going to have to familiarize themselves with. So thank you, Marcos. Thank you, Yves, and thank you to everyone for joining us.
Bye-bye.
Bye-bye. Have a good one.
Bye.
Thank you very much, Marcos.
Bye. Thank you. Thank you for the meeting. Bye.